time and time again that if you follow the price of oil, you should be prepared for whiplash. In fact, the price of U.S. Brent crude is up nearly 40% since mid-March, sparking concerns that inflation will soon follow. Oil was down near $40 a barrel at one point, is now over $60, still well below its highs last summer. Joining us now is Darren Shuning, managing partner at Yorkville Capital Management. Darren, good afternoon to you.
Hey, hello, Andrew.
Okay, let me start with why do you think prices are going up? Is this a capacity issue and unrest in the Middle East more than a demand issue?
It is a oversupply issue, which is what has caused oil to come down from over 100 to below 50 and now bouncing back up to over 60. And what we've seen recently has been actually demand increasing. And today there were some numbers out that look really good on the surface. We saw inventory drawdowns, which means higher demand. So Europe's coming stronger demand, or showing stronger demand. China's showing stronger demand. That's good. I mean, you're going to bring a market back into supply one of two ways. Cut supply, which the U.S. has cut its rig counts by 56%. You cut your rig counts first and supply will come off eventually. We haven't seen it yet. Or you increase demand. So demand's growing. Rig counts are down 56% in the United States. The markets are looking forward and saying, what's the fundamental price for oil? $60 a barrel seems about right.
You know, I'm surprised to hear that Europe demand is going up, because just a few months ago, we were talking about how poor demand was in Europe and China.
Absolutely. So it's almost a schizophrenic market, isn't it? For one time, we're worried about recession, and then a couple of months later, demand's looking better in both China and out of Europe. Part of it, in my opinion, and our opinion as a firm, is that you have a stimulative effect that the market overlooked. You cut the price of a commodity, it's going to increase demand. There is a bit of incremental demand, supply side demand, that's marginal demand, incremental demand that comes from more driving, more consumption of oil. So not baseload demand, but consumer-driven demand.
And what role then does Saudi Arabia have in this? Because we all believe that Saudi Arabia wanted to intentionally suppress prices to punish Iran, to punish Russia, to punish Syria, and to punish the United States. Are they happy? Do you think they're comfortable with a $60 price level?
I think that doesn't bring the pain that they wanted to see. So Saudi Arabia certainly punished its enemies, for lack of a better word. It did hurt. It hurt the countries that you mentioned. In the United States, it didn't destroy the supply side the way that Saudi Arabia was hoping. $60 barrel of oil. If you look at the budgets in E&P companies in the U.S., they were looking for $55 a barrel of oil for 2015. So 60 is above the budget levels. I think that that means supply coming online out of the U.S. and being curtailed much more is not that great. So from a supply side at 60, you're not going to see much of a reduction in supply out of the U.S.
Yeah, I was going to ask about the fracking industry. We were starting to hear about layoffs. We were starting to hear about the cutting of capacity. Now, this has got to be good news for states like North Dakota, for Oklahoma, for Pennsylvania, for states that are heavily involved in fracking.
Yeah, it's very good news. It's good news for the energy industry overall. Fracking, when I look at the United States, I think what most analysts or observers, casual observers on the market are missing is that the United States right now, when it comes to fracking, we're only recovering 10% of the resource. When we do traditional vertical drilling, we're pulling out 80% of the resource. Now, we've been able to increase the recovery rates by 25%, so your revenues have increased by 25%. We're still pulling out now 12.5%. We double our recovery rates, go to 20%. Our price drops in half virtually, so $60 barrel becomes $30. The United States, because of this ability to increase productivity or the amount of the reserve we're able to pull out of the ground, we're going to be the cheapest energy producer, or one of the cheapest energy producers globally. So not only are we going to increase production significantly from 9 million barrels per oil today, estimates are 16 million barrels in the next 10 years, we're going to be the cheapest producer as well.
I want to jump in quickly on gas prices, because consumers are saying, well, shocker, prices of gas are going to go up just as we're getting ready for the summer season. It sounds like to many that it's a manipulated market.
You know, it's a pretty difficult market to manipulate right now. It's a free free market. I don't think it's manipulated. The pricing is coming down legitimately. We actually saw a little bit of build in gas inventories today from the headline numbers. That would actually be positive for gas prices to come down again. I think it's a fair market. Prices got oversold. They're back into a more normalized range based on the cost of pulling oil out of the ground today. So I think it's fair. Gas is still relatively cheap from $5.
And still much cheaper than it was last year.
Yeah, absolutely, right? So stimulative again for the U.S. economy.
Darren Shuringa, thank you so much.
You're welcome.
And coming up, next stop, Cuba. By plane and boat, companies are lining up to take you. Arise Xchange continues after this.